Good evening, everybody, or good afternoon, depending on which part of the world you are in. Today we are going to be discussing how to trade the news effectively as a binary options trader. I hope that you can hear my voice clearly and also see the screen in front of you clearly. The agenda, as always, is to give you a really quick introduction on who we are, and then I will delve into the subject matter discussing price action versus mean reversion. These are the two types of markets that you will encounter as a binary options trader. I will then give you some prescriptive steps on how to trade the news effectively. It is one of many news trading strategies that you can deploy on your binary.com accounts. All right, there are a variety of news trading strategies. This is just one. And then last but not least, I will discuss some key risks that you should avoid as binary option traders that are specific to the currency trading market. Okay? To give you a little bit of background on our group, we are Blue Sky Binary. We're an advanced binary education and trade recommendations company. We're a group of senior traders that teach a variety of binary options strategies, both short-term and long-term. We also provide 24-hour trade support and analysis to allow binary traders to trade safer. BSB, in collaboration with binary.com, is delivering these webinars to educate you, their current or future potential binary option trading members, to become successful binary option traders. Binary.com meets our high watermark for quality as a highly trusted broker in this industry. So whether you're trading random indices or you're trading currency options on very short-term price movements, maybe just a few seconds or a few minutes up to a few hours, maybe even end of days, generally speaking, you will see that the market is either breaking out, trending, all right, or mean reverting, which means bouncing within a support and resistance range. The trending market, or the one that's breaking out, is normally driven by news, like we see with the FOMC minutes today in the U.S., or we see with non-farm payrolls data also out of the U.S. These are key event-driven trading market conditions, all right? They're driven by events. Identifying them is a little bit more difficult, and this is what we're going to teach you today. There are specifically 5 to 6, sometimes 7 key news items that drives trending markets, all right? And that's what we're going to train you to pick up on today. The other type of market, which happens around 70% of the time, is the range-bound market, where the market kind of moves on between one support and resistance level, not really having a direction. All right? Those are slightly easier market conditions to trade in. The trending market, which occurs after news, is a bit more difficult, but because you are betting or trading in the direction of the trend, you have a higher likelihood of win. Also note that specific to the binary.com platforms, and this is very unique to binary.com as a broker, is that trending markets, if you get the trade right, you are rewarded with a much higher payout, right? So if you look at the payout percentage on your traditional binary.com bet, you will get between, let's say, 70 and 80% at times payout, right? And in some rare instances, 50 to 60% depending on the time of day. But if you are trading in the direction of the trend, which is statistically more difficult, you are rewarded also, therefore, with a much higher payout, up to 108% at certain periods during the day. All right, so if you get news trading right on binary.com, it can be a very, very profitable money-making strategy. All right. So there are 4 things that you need to take into account when you're trading the news. Firstly, pre-plan what news events you're going to trade on any given day, right? So today, for example, you had a relatively heavy economic docket, all right? The term docket is used in this industry to define how full the economic calendar basically is. And today you had CPI data out of Canada, and I think as I speak right now, FOMC minutes. All right, I don't have access to charts, but I'm assuming there's been a little bit of movement at the least, if not fireworks. Every time the FOMC or the Federal Reserve releases information about monetary policy, it causes the market prices to jump for all currencies. And that can be a tradable opportunity as well, which I'll teach you shortly. But the key thing to note is that it's very important that you pre-plan the news events, right, on a specific day. For example, if it's non-farm payrolls day, which is the first Friday of every month, you want to know that at least 2 days before. You got to pre-plan it. It's not good to trade news on the fly, right? It takes a bit of prep. The second thing is you have to understand the macroeconomics, right? For those of you that are here, you are here because you understand that news trading can be very profitable. And Binary.com, unlike other brokers, rewards news trading with much higher payouts, right? If you get trend trades right, you're paid out much higher than usual. But you can't trade news without some good grip over fundamentals, macroeconomic fundamentals. So we're going to go over those today as well. Thirdly, and this is a more obvious one, is basically that understand news is a price action strategy, right? So it's a trend strategy. 90% of binary option traders and FX traders don't know how to trade trends. They are focused on trading the bounces, right? So if something moves up too much, if it's overbought, they sell the exhaustion. They sell into strength with the hope that it will revert, right? That's what most of us do. News trading is actually quite different. You're actually trading in the direction of the trend, right? For this specific strategy. There are other forms of news trading which we'll cover on subsequent webinars, but the most common one is where you're identifying the trend and you're taking a trade in the direction of the trend, all right? And then last but not least, trade calibration. This is quite easy. Getting access to a legit chart provider. Binary.com has some decent charts as well. There are other free chart providers out there that give you industrial strength charts where you need to have candlesticks up. You need to add Bollinger Bands, otherwise you're trading blind. And we'll go over those specifics as well, all right? So with regards to pre-planning the news day, as I said earlier, don't trade news on the fly. It's a tricky, tricky animal, all right, to tame, and it takes a bit of time. So definitely get access to an economic calendar. It's available on Google, all right? You just have to type in FX economic calendar. Binary.com offers one as well on their website. The economic calendar is typically planned a month in advance, up to 3 months in many cases, all right? And it shows all major country-specific economic and often even political news events such as votes and referendums and event releases which could impact currencies on any given date and time of that day, right? So it's a very, very important part of your trading. And for those of you that know what an economic calendar is, I'm sorry I'm going over such basic stuff, but for those of you that are new, it's absolutely essential that you get access to an economic calendar if you're trading the news. What is also equally essential is do not focus on the noise, right? There's a lot of noise out there such as low impact events, medium impact events. For example, U.S. initial claims data is generally noise. It may move the market a little bit, but the jobs number that everyone cares about out of the U.S. is the non-farm payrolls number, right? So focus on the 4 out of 5-star events, if not the 5 out of 5-star events, or in certain calendars they are demarcated in red, right? Not orange, not blue, but red. All right, so this is an example of an economic calendar. This is just a screenshot. This is not live. But what you will see is that immediately I'm not really that interested in medium or low impact events. I'm going to go for the high impact events. And in this case, the only high impact event here was at 8:30 in the morning. All right, and this was the affecting the British pound or cable. And it was the Bank of England minutes, which is the UK or the British equivalent of what you're having in the US as I'm giving this webinar, which is the FOMC minutes, right? So the Bank of England regulates monetary policy. It dictates interest rates, inflation levels, and to a certain degree growth levels in the UK by regulating the supply of money into the UK economy. And they do that using the interest rate channel. So the minutes are very important because they give the investor a gauge on future interest rate policy. Anyway, we'll get into that just in 2 minutes, but the point of this screenshot is focus on the high impact events, right? The others are just noise, and you're going to get stuck in bad trades if you try and trade every single event. It just won't work. There are 6 events that we have classified, categorized, and zoomed in on, if you will, from about 10 to 15 high impact events. 6 carry very, very significant impact, or have very significant impact, And one of these actually has the ability to change the fabric of the markets as we know it. And I say this because we've seen this happening sometimes in the last few years. These are known as Six Sigma events. You don't want to be trading on these days, right? You do not want to be messing with real money on those days. Six Sigma events is where the entire assumptions of institutional hedge fund managers, portfolio managers, investment banks, sovereigns, retail traders, everyone who trades currency, they change after that day. And we had that last with the Swiss National Bank last year, the big event, the SNB event, which was a surprise, where the Swiss National Bank actually removed the peg versus the euro, and that caused a 1,500 pip fall in the pair, Euro CHF, and that liquidated not only people's accounts that didn't have stop losses in place, but entire currency brokerages. That's how dangerous news can be, and that's known as a Six Sigma event. So, and those are not tradable. Just to be clear, those are not generally tradable, but it's important to know that they exist, and it's important to identify them in your economic calendar, right? If you don't want to blow your account. So, let's start with interest rate decisions. These are not Six Sigma events, but these are high liquidity, high focus events, right? And the interest rate decisions, whether they are coming out of the Federal Reserve for the U.S., and pertinent to U.S. monetary policy and U.S. inflation levels and U.S. economic growth, are as important as those coming out of the European Central Bank, delivered by Mario Draghi, who's the chairman of the European Central Bank. He regulates, him and along with his team, regulates the supply of euros into Europe, basically. And interest rate decisions will directly impact the base pair. In Europe, that would be the euro, and the US dollar. Okay, it's a direct impact. And the way you trade an interest rate decision is you trade the difference. In fact, with any news, you trade the difference, the surprise. For example, if Eurozone interest rates right now are 0.005%, near zero, right? And suddenly things get excited, the policymakers get excited, and everyone gets happy in Europe for whatever reason, and they start talking about an interest rate hike cycle. Let's say in the next year or two, Europe wants to normalize interest rates as the economy starts to improve and stabilize. Then what the market will do is they will start to say, okay, at the next European Central Bank meeting, interest rates will be raised by 1/4 percentage point, right? A 1/4 point raise to 0.25 or maybe 0.5. So if the market is expecting 0.25 for the next meeting, right, and let's say today is the next meeting and it's about to happen, and the actual news comes out that they have raised interest rates by 0.25, that's not really going to move the market. You're going to get spikes up and down because there's always recalibration of portfolios, and hedge funds are always buying and selling for other reasons, but you're not going to get a trend, right? Because investors already knew that they were going to raise. So you're not actually, what you actually want to do is you want to trade the difference or the surprise. For example, if the market is expecting the European Central Bank to raise rates to 0.25% today, and the European Central Bank only raises it to 0.10%, right, or doesn't raise it at all, that's very bad news for the euro, in the sense that the euro had already risen. Remember, if interest rates go up, it makes the currency more valuable, more attractive, all right? And so if interest rates haven't gone up, as the ECB had hinted, then what's going to happen is there's going to be a unanimous decision by market participants to sell the euro, and that causes the euro to drop in a breakout. And I'll show you how that breakout looks later. It's a very traditional formation in the markets, and you can trade that breakout very, very nicely to your profit. All right, so with interest rate decisions, if they are in line with expectations, you're not looking to trade them. If they're ahead of expectations, you open a trade in the direction of the beat. So if it's better than expected, it's going to make the underlying currency rise. If it's worse than expected, it's going to make the underlying currency fall. Okay. But the thing to note about interest rate decisions is it's not that easy. I would say 50% of the time it is that easy, but some of the time the numbers are in line with expectations. So you think, okay, nothing really happened. I just wasted a day waiting. what happens after that is that there's a press conference that typically follows 30 to 45 minutes after the actual numbers are released. That press conference can either reiterate the data, so back it up, which means there's not going to be too much market movement, assuming that the rates were in line with expectations, or the policymakers, in this case the chairwoman Yellen of Federal Reserve, or Chairperson Draghi of European Central Bank, or even Carney of the Bank of England, they may actually come out and say something quite different than what the numbers are saying. They may actually say, okay, we haven't raised rates now in line with expectations, but it looks like the European economy is doing much better than expected on the job front. And on the inflation front, and you know what? We're actually going to accelerate the rate raise cycle. Only it's going to start a bit later. Now, what will happen is immediately the euro will shoot up, right? Because what the market is doing is it's pricing in future information. The market is always looking for clues about the future, right? They don't care about today's data, and they certainly don't care about the past. It's always about the futures. So be careful of those conferences. They are specific interest rate decisions. Be very careful, because sometimes the policymakers may take a very dovish or bullish stance, hawkish being the correct technical term, stance in those conferences, which may tend to negate what the data or the report that was published 30, 40 minutes earlier actually says. Then you have GDP releases. Now, GDP is the total economic output of an economy. It's actually it's an acronym, but what it actually means is gross domestic product, right? And it's measured by taking the total consumption by consumers in an economy, adding the total investment by the private sector, plus the investment by the government sector into the economy, and then basically adding the net exports. And by net exports, I mean exports minus imports. Okay, so the equation is C plus I plus G plus X minus M, right? Consumption plus private investment plus government expenditure plus net exports. And that's what comprises and drives an economy forward, right? Now, if the number, and again, it's always expressed in the economic docket as a percentage versus the previous month or versus this time last year, known as year on year. What has the growth been in the last month? Or month on month? How has the economy grown from March versus February, right? And what you're looking for, ideally actually, is a year on year figure. And the economic calendar will show that. And again, you're going to play this the same way I told you would play interest rates. If interest rates were ahead of expectations, you would go long the underlying currency or open a call or an up position. With GDP, it's slightly lagging, okay? But generally speaking, if they are expecting a print of, let's say, 2% growth year on year, and it comes out at 2.5%, that's a significant beat. So it's probably going to result in strength in the underlying currency. If it's a slight beat, I mean, this is important to take into note. If it's a slight beat, if it's, if the expectations are 2% and they came out at 2.1%, that's not going to move the needle. You don't want to play that. That is a beat, but it's not really a big beat, right? And even if it's 2.2%, you want a significant beat, all right? And with that in mind, let's move to CPI releases. So the CPI is actually the Consumer Price Index. This is important. We have this data from Canada today, if I'm not wrong. And what this shows basically is inflation in the economy, right? The value of goods and services, the price actually of goods and services rising in the economy, right? And what you want in an economy is that your wage growth as an employee rises in line or at least in line or higher than the growth of the products and services around you in the economy. Because if your wages are not increasing in line, you are facing inflationary pressures on a private consumer basis, right? Your individual, each and every dollar you get every month as a salary is worth less and less. You can buy less hamburgers with it, right? Or whatever. That was kind of out of the term from the 90s, but whatever you would buy now, right? So the point to take on board is the CPI level actually measures the level of price inflation in the economy. Now, you don't want no inflation, because that means there's actually a demand problem, right? If food producers and retailers and electronic stores and all that stuff, and shoe producers and fashion producers, if they can't increase prices that means the consumer is not actually willing to spend, and that's an inherent problem in the economy, right? So certain levels of inflation are important, typically 1 to 2%, right? If you look at the Federal Reserve in the U.S., their mandate is to keep inflation at around 2% a month. The thing about CPI is this actually gives market participants and the central bank a good read into the economy's level of inflation. So if the consumer price index is coming in ahead of expectations, right? So if prices are moving at 4% when the expectation is only 3%, what that tells you is that inflation is running ahead of expectations. Too much inflation erodes the value of your currency in your hand. That's bad for the economy, right? So the way the central bank combats that, what do? Right? They increase the value of the currency to control inflation. How do you do that? You raise interest rates. So now you can immediately make the connection, all right, that a higher than expected CPI number will probably result in a sharp rise in the underlying currency, because immediately investors and traders will say, aha, if CPI, if inflation is running ahead of expectations, the government has to raise rates at the next time, right? And the mere expectation of this is what makes the currency move up, not the actual fact. Remember, the fact, no one cares about the day the data is released. It's in the past. People actually price in future anticipatory moves today. That's what the market is looking for, right? So the CPI today that's released will give you a clue on interest rates in the future, and that will make the currency move. And it's quite similar to job levels. Job creation specifically is very important, especially in beleaguered economies like the U.S. And parts of Europe. And even we see a slowdown in major economic growth engines of the last decade like China. So people are focusing on job creation. Job creation is the lifeblood of any economy, especially economies that are driven by consumption, right? Because if you look at the U.S. economy, the composition of its GDP, if you remember, I went through the GDP equation, right? The gross domestic product is consumption plus investment plus government expenditure plus net exports. C, which is consumption, right, the letter C, is too big in the U.S. It's almost 60-70% of the entire economy, which means you need a lot of people employed, whatever it is that they're doing, right, to actually take their dollars and buy stuff. Because if they buy stuff, then companies sell stuff, and that increases GDP, which is good for the economy. But if the U.S. is not creating jobs, right, there aren't enough people to buy stuff, which means the GDP is going to be weak. So jobs numbers, specifically non-farm payrolls numbers, which are released on the first Friday of every month in the U.S., are of specific importance, and they are probably the most researched and, sadly, I have to say, also overhyped number today. Yeah, everyone loves to trade the NFPs. Brokerages around the world love to get clients excited about it. For us, it's just another data point, and it is tradable. But what you have to basically know is to trade this is you want to trade the big surprise, like with GDP numbers, the big surprise, right? So typically, the non-farm payrolls number, the expectation will be around 200,000 jobs created in the last month in the non-farm sector in the U.S., right? If the number comes out at 225,000 jobs, that's how much is that? That is a, roughly speaking, 10-12% beat, right? That's a significant beat. 250,000 jobs is a real beat, right? Equally, 150,000 jobs is a big miss. So you trade that. It works exactly the same way. A better than expected number lifts the dollar. A worse than expected number creates a drag. But again, you don't want to trade lackluster beats, right? So for example, if the expectation was 200,000 and the number comes out at 205,000, you're probably not going to get any strength. You might even get a sell-off, because the bulls that were expecting a huge frenzy, a number like 300,000, they get disappointed and they just exit their positions, their speculative positions. So don't trade slight misses and slight beats. And then you have, let me get to consumer confidence data first. I'll reroute to parliament votes, because that's a Six Sigma event, right? You get consumer confidence. This is an interesting one, because this actually measures the economic sentiment by the average consumer that basically will determine the overall GDP of a consumer-centric economy, for example, like the U.S., right? Germany, for example, is a manufacturing-centric economy, so its focus is more on I, which is the private investment variable in the GDP equation. consumption is a small portion of Germany's GDP. Manufacturing and exports is huge, right, because of German machinery and all of that. But in an economy like the U.S., which thrives and depends on consumer spending and spending more, the letter C is very important. And so consumer confidence data, which is typically measured as an index, above 50 means excitement and under 50 means sadness, basically bluntly put. And you want to trade a beat there or a miss there, right? And that's what consumer confidence data is. But you need to put consumer confidence data in perspective with the underlying economy. Consumer confidence data is not so important in Germany. It's very important in the U.S. for the reasons I mentioned earlier. Now let's reroute to Parliament votes as the final and one of the most important tradable news points. Every once in a while, you will get major votes by parliaments, either the Conservative Party or the Democratic Party. And this can determine the underlying fate of economic policy and monetary policy in the future, and business as well, right? How friendly an incumbent administration is, or the new incumbents will be to business in the economy. And it always comes down to that. And you will get major votes, like we had the Greek Parliament voting 2 years ago whether they want to leave the European Union, and that was known as the Grexit, if you recall. Greek and exit, you put them together, Grexit, right? That never happened, but you remember the amount of volatility the euro faced, because if that would happen, you could get an unraveling of the European Union, or at least that's what the fearmongers were saying back then, right? Because if Greece left, it would make a precedent that nobody else would need to pay their debt, so Italy may leave, Portugal may leave, and the entire European project would unravel. Now that didn't happen, which is a very good thing. But it created a massive short opportunity in the euro back then, right, if you traded it correctly. And the same holds true for what's going to be happening on the 23rd of June this year, where the UK public is going to have a referendum, a final referendum on whether they want to stay or leave the European Union and the European project, which we've done a webinar on this recently called the Brexit and the impact of Brexit on currency trading. We're going to be doing this webinar for Binary.com very soon, so you should definitely attend that one, because that's a Six Sigma event. That specific day, you probably shouldn't trade unless you're very brave, but it's going to kick into motion a range of changes in economic assumptions for the rest of the year and the next year across the world. Because London is such an important financial trading hub, a departure from the euro or from the European Union could have significant systemic effects for currencies, especially GBP-related crosses like British pound, Japanese yen, British pound USD. For those of you that trade cable, you could get some pretty asymmetric volatility in those pairs setting in. Okay, and so it's important you attend that webinar, but equally important that you have your economic calendar up, right? And you specifically don't trade that day, because that is a Six Sigma event. It could move the market up or down by hundreds of points, right? And so Parliament votes are never that simple, right? There are a lot of known unknowns and unknown unknowns about the future of economic policy and what happens if this happens, if that happens. And so, but they're just important. They're there because they are docketed. They are put in the economic calendar. So those are days that you should watch out for. All right? So we are about 70% through. When news does happen, okay, now let's talk about trade specifics. I've been giving you a lot of macro. Let's talk about actual technical trading. What you typically get, and this is a 10-minute chart, this you can also have on a 15-minute chart or 30-minute chart. If there's news, it will show this pattern on most charts. What you typically get is convergence. The upper Bollinger Band and the lower Bollinger Band, they start to face each other going into the news, and that's because the market is consolidating. And then you get a breakout. In this case, a breakout north, because the news has been very good for the euro, and you see that the first candle and the second candle closes outside the upper Bollinger Band, crystallizing or confirming this breakout, and you get divergence, where the upper band and the lower band, they literally look like an alligator's mouth. It's open, right? And the moving average, which is the middle band, is firmly facing up, creating a support opportunity. When you see this formation and you have done the analysis that I've shown you here, and you understand why the price is rising or falling, you can open a trade, typically 30 minutes, end of hour expiry or crossover, which is 30 minutes into the next hour. These are the type of expiries you can trade, potentially trade with. All right. Let's discuss calibration briefly. So with regards to when to enter, news typically takes around 15 minutes to create a trend and then continue in that direction for a trend. Immediately when the news is released, like literally a second or 30 seconds into it, you should abstain from trading because a lot of that can create false direction. Something may spike up because you get a big buyer like Deutsche Bank, and then suddenly actually the news is actually bad. Deutsche was just buying for another reason, and you get a big spike down. You don't want to get stuck in that upward spike. So news typically takes around 5 to 15 minutes for the market to assimilate. You're not going to miss out. Don't worry. Do not enter for the first minute or at least first 5 minutes, right? And if the price spike moves significantly against you, let's say in the first 5 minutes it's already 150 pips, you don't want to chase that move. The first candle, the first hourly candle in major news events is rarely bigger than 150 pips. Normally it's 100 and then it retraces a bit, right? So if it's moved 200, you've already missed it. But that's rare, right? You will miss a few pips, but understand that it's better to miss a few pips rather than just enter like a goat just immediately when the news is released, right? So yeah, setting your expiries, 30 minutes, not shorter, unless you're unless you have you have thick skin or you're trading with very small amounts. An hour is fine. And very important, of course, as I mentioned earlier, is to have candlestick charts up and Bollinger Bands, right? So it should look like this. Here are my candles, and here are the Bollinger Bands. All right, so let's discuss some key risks to avoid in currency trading. Right? Do not trust robots. Okay, 99% of them don't work. Not all of them. Some do work and they meet a certain need, but generally speaking, robots are designed to deplete accounts in the industry. Again, that's a generalization. It does not apply to all bots. Also, please note that a small percentage of traders actually make money in the long run, right? A lot of traders can make some money in the very short run, but under 5% are making money in the long run. And the reason they are making money is because they actually understand the macro, what you've learned today. They understand the micro, the technicals, and they combine the two to navigate the markets safely. For example, someone who doesn't understand the Brexit, who doesn't understand the importance of Six Sigma events, will just wake up and say, okay, there's a vote in the UK today, I'm going to try and trade it, right? And suddenly they see a big spike, and they see a spike, they keep martingaling against it, and they've blown their account. However, you do understand the news, so you already have an advantage. The point I'm trying to make is the more you invest in learning and educating yourself, you're going to be more in the know, so to put it, along with the real institutional hedge fund traders that do this for a living, right? Because you're just a retail trader. So naturally, you're slightly disadvantaged, right? You're trading against the guys and the girls that are sitting in the investment banks and working for the prop desks. So, and you can certainly be as good, and the tools are out there, right? You don't have to spend a lot of money or anything like that. But the key is to invest the time to learn. And that, as a corollary to that, part of learning is also losing. I've lost money. Everyone has lost money at some point in binary options and FX, and it's perfectly normal because that actually allows you to calibrate your circuits, your emotional circuitry, and learn how to lose. Because you will lose at some point. There's no one who has a 100% win rate. Nobody I've met has a sustainable win rate of over 67%, which, by the way, is phenomenal because they're winning 2 out of 3 trades, right? So the thing is, don't get disheartened by losses. Just start small and understand that the market is very asymmetric. It is complex. It's nonlinear. So it's important that you take that on board. Okay? Okay, I will now take questions. So please go ahead and ask me any questions you may have. And after that, for those of you that still wish to stick around, I want to show you a cool little service that we have called SignalHive Hybrid, which connects to your Binary.com virtual or real money account. And we offer a free trial as well. So you can give it a shot, and you can join a community of a few hundred members that are trading their Binary.com accounts with SignalHive. All right. But before I get to that, please ask me any questions you may have in this webinar. Sure, Ronnie. I'm glad it was of help to you. Any questions from anybody? This webinar is recorded, by the way, so in case some of the concepts were very new and I went over them a bit quickly, you can listen to the recording, of course, on binary.com. Last call for questions before we move on to the second part of the presentation, which is on Signal Hive. Okay, so I'm going to share my screen now. Basically going to share my desktop. Give me one moment, please. Okay, I think you should be able to see my desktop now. All right, I received confirmation from Charis that she can see my screen. So this is Signal Hive, all right, and this is a marketplace for signal providers and binary option traders to take their signals. You have robotic signals here, different types of streams that have different types of strategy and fire at different times of the day. Okay. You have full embedded charting as well. You have human signals that you can subscribe to, and all these human signal providers are listed here to the right, and they each have their own different type of time zones and types of binary options trades that they do. You can also view the performance of each signal provider in a very transparent manner through time. And you can participate while you're trading in technical discussions with other traders who are also trading these signals and other strategies throughout the day. Now, the beauty about this product is, firstly, it has a free trial for a week, so you can really test it out at no risk. You can also connect it to your binary.com virtual money accounts and test out how good the signals are there. And you can auto-trade them as well, so you don't need to be in front of your screen all day. We offer something that is known as hybrid technology that is unique to binary.com. It allows you to set the amount per trade, the risk engine settings for each trade as well, and you can semi-automatically or automatically trade each of the signal streams. Okay, and this is linked to your binary.com account via the API token. Please feel free to contact us at support@blueskybinary.com or add Blue Sky Binary on Skype. We are located at www.blueskybinary.com or www.signalhive.com, and we offer a free trial for 7 days, and it's a product that interfaces with your binary.com account. All right, that's it for now. Do you have any questions on Signal Hive? Okay, thank you all for your attendance, and I will see you all shortly. Good luck.